Fed will pivot when the market makes them, and the number one thing to make them pivot is probably the stock market going down, the S&P 500 dropping at a higher velocity. It's been hovering around this 4,000 level, up or down 200 points from that. And I think it's just inevitable at some point it tilts back down because the Fed's not going to ease, it looks like, until it doesn't. I mean, the jawboning from the Fed governors is quite serious. They keep talking about higher rates, despite the data we've seen all this week. They're starting to get that trend of misses, misses on PPI, misses on retail sales. It's just, to me, part of what happens in a recession. I think that's the stage we're at right now.
Bloomberg Intelligence senior macro strategist Mike McGloan shares his optimistic outlook on the gold market. Despite a slight dip in gold prices following its second highest settlement level ever on Thursday, McGloan pointed out that the precious metal is still set to record a 7th consecutive week of gains. In his expert opinion, gold is expected to surpass the $2,000 per ounce mark and continue to rise, with the stock market possibly playing a key role in the process. McGloan further elaborated on his bullish stance on gold, stating that it is one of the few commodities that he believes will thrive in the current economic climate. He attributed this to the ongoing shift towards deflationary trends across various sectors. Additionally, he noted that if the Federal Reserve does not pivot this year, the market will make them, and the Fed will have no choice but to adjust its approach accordingly. McGloan also discussed the relationship between crude oil and gold, highlighting how deflation in fossil fuels is causing inflation in gold. This interplay between the two commodities is expected to further strengthen the case for investing in gold. For investors looking to capitalize on this opportunity, McGloan suggested buying gold, adding that exchange-traded funds, ETFs, have made this easier than ever before. Let us now get into the video and listen to McGloan. Don't forget to like, subscribe, and turn on notifications.
But I think it's inevitable that gold gets above this $2,000 an ounce level and never looks back. And the key catalyst is the stock market potentially rolling over. And here's a big difference with gold compared to the stock market. I look at gold versus the S&P 500. It's very low on a 120-month basis. A 10-year basis is basically unchanged. The stock market total returns around 300% or so. Those are starting to reverse. And the big difference, the last time we did this was really around the start of the new millennium, was the Federal Reserve was well into an easing cycle. So I see this as just the catalyst for gold to take off. It's one of the few commodities I'm really bullish on because everything's starting to tilt downward towards deflationary trends. 2-year note yields, 10-year notes are getting it, but the Fed is still being vigilant against inflation, which is collapsing. You look at PPI, I see PPI in a year-over-year basis heading towards negative by the time we get to July. And that's just what happens normally when commodities collapse. The crude oil is an enduring bear market that had a bounce last year and tilting back towards that bear market aggressively. On a 12-month basis, it's down about 20%. $80 a barrel in this year's range has been between 65 and 85. And still, it's the upper end of range. I think it's going to go lower. And follow natural gas. Natural gas has dropped 80% from last year's peak. It's the number one measure of heat, electricity, and fertilizer in this country, and it's at this cost of production, a price that first started trading in 1990. I think crude oil is going to do that and go towards 40. So basically, deflation in fossil fuels is encouraging inflation in gold. And I think that's just starting to kick in and accelerate. You see the end of the quarter, end of 1Q close in gold was the highest ever. It's just hovering around that $2,000 level. And the key question I ask is what stops this? The Fed is still tightening. Typically, when you have commodities collapsing at this velocity in the past, the Fed has already been easing, and they're still vigilant against that. So I see what we're doing is heading towards a severe deflationary recession, as indicated by commodities, by the Fed still tightening, the curve's significantly inverted, and now we have a pretty serious credit crisis going on with just pulling back of deposits from the major banks. That means it's just starting to get started. And the key thing I'll end with is that we were just looking at annualized industrial demand for natural gas in this country. It's the lowest in 6 years now, and that's an annualized basis, so it's not seasonal. ETFs are such an easy way to do it. It's quite clear, but I think one thing that's going to be coincident with this gold rally is the rally we're having in U.S. long bonds and declining yields. So ETFs are just an easy way to express those views and investments. In the history of miners, you have to be more selective. You can get those many X's of returns, but you have to be selective. The overall miners, like the GDX index, has a history of underperforming gold over time. And the key reason for that is you just can't create more gold cost effectively like you can crude oil and a lot of other commodities. So overall, that physical ETFs that track gold have a history of outperforming indices like the GDX index, which is just an index of miners.
IRA allow you to save for retirement in a tax-advantaged way for greater financial security with lots of tax advantages. But most IRA offer the same boring stocks and bonds. Introducing iTrust.capital, the #1 crypto IRA platform in America. iTrust.capital allows cryptocurrency investors like you to enjoy all the exciting benefits of tax-advantaged retirement accounts. It combines the traditional IRA with the new, exciting world of cryptocurrencies. Why should you use iTrust.capital? It is the best crypto retirement platform in America, with some of the lowest fees of any cryptocurrency IRA platform. It gives investors adequate exposure to some of the top cryptocurrencies like Bitcoin, Ethereum, Cardano, Solana, and Polkadot. You can buy and sell all your favorite crypto assets while enjoying amazing tax-free gains. It is adequately secured by Coinbase custody with a $320 million insurance to protect against theft. You can easily roll over an existing retirement account or begin a new one when you register on iTrust.capital. iTrust.capital is the trusted crypto IRA for many American investors who love the crypto industry. To join the millions of Americans who use the platform, please click on the link in the description box below. For now, it seems markets are brushing aside U.S. recession woes. Instead, they are focused on pricing a pivot from the Federal Reserve towards the end of this year. But think about what that could mean. Inflation is still high and policymakers have downplayed expectations of rate cuts this year. As such, if there is a realignment, then volatility could come back into play for Q2. Recession fears could start to pick up again as U.S. consumers cut back on their spending, with retail sales numbers dropping more than expected last month. U.S. retail sales dropped 1% in March, following a revised 0.2% decline in February, according to the latest data from the U.S. Commerce Department. Economists expected a decrease of 0.4% in last month's headline number. Core sales, which strip out vehicle sales, also missed expectations, falling 0.8% last month versus the projected decline of 0.1%. The report's control group, which strips out autos, gas, building materials, and food services, dropped 0.3%, falling in line with the consensus forecast. The disappointing economic data is not having much impact on gold as the market sees some technical selling pressure after Thursday's rally to a fresh 13-month high. There are some early signs of cracks beginning to form in the U.S. economy as momentum fades. This is mostly coming in the form of economic data that is missing expectations and weakening from previous prints. What could this mean for financial markets in the second quarter? Let us hear your opinions in the comment section below. Also remember to drop a like, subscribe, and turn on notifications. Thanks for watching.